Ever wondered how the rise of remote storage solutions is reshaping the retail real estate landscape? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In today's segment, we're diving into a fascinating development in the retail real estate sector. The recent transformation of a U-Haul retail showroom in Brainerd, Minnesota, into a remote self-storage facility is not just a local story, it's emblematic of a larger trend sweeping the industry. This shift highlights the growing move away from traditional retail spaces towards tech-driven, asset-light logistics models. U-Haul's strategic decision to close its physical showroom while maintaining its truck rental services through an app demonstrates a new way of thinking about real estate, labor, and customer interaction in the 21st century. This trend is particularly relevant for investors who see both risks and opportunities in underutilized physical assets and the evolving logistics landscape. The decision to close the North Baxter retail location while keeping truck rentals accessible through a mobile app highlights three key realities. Firstly, there's a declining demand for physical retail spaces. U-Haul's move reflects a broader trend of retailers closing underperforming stores, driven by the fact that fewer customers need to visit a showroom to rent a truck or purchase supplies. Secondly, tech-enabled self-service models are on the rise. U-Haul's Truck Share 24/7 service allows customers to unlock vehicles via their smartphones, reducing the need for staffed locations. This mirrors the rise of app-based car-sharing platforms like Zipcar, but applied to a logistics giant. Lastly, the need for cost discipline in a low-margin sector is undeniable. U-Haul's recent net losses underscore the pressure to cut costs, and remote storage facilities, requiring minimal staffing and maintenance, fit this imperative perfectly. This move aligns with U-Haul's acquisition of KO Storage's Minnesota properties in 2024, expanding its self-storage footprint. By converting underused showrooms into storage units, U-Haul is repurposing its real estate portfolio to meet the surging demand for storage, which has grown 6% annually since 2020. This case study reveals a seismic shift in how physical assets are valued. Traditional retail spaces, once the crown jewels of commercial real estate, are now liabilities if they fail to generate sufficient foot traffic. For investors, there's an opportunity in repurposing former retail sites, such as strip malls, big box stores, or vacant showrooms, into micro warehouses, electric vehicle charging hubs, or self-storage facilities. However, there's also a risk in over-reliance on physical labor. U-Haul's layoffs at North Baxter signal a broader trend where automation and remote management are eroding demand for low-skilled retail jobs. This shift isn't just about real estate, it's about labor, too. U-Haul's layoffs highlight the downsides of efficiency, but they also point to new job creation in tech support, data analytics, and maintenance of automated systems. The workforce of the future will increasingly require skills in digital infrastructure, not just manual labor. For investors, this means backing tech enablers, firms that provide Internet of Things sensors for storage units, cybersecurity for app-based logistics, or artificial intelligence-driven inventory management. Companies like FedEx or Amazon in adjacent sectors could benefit from this trend. Meanwhile, companies clinging to costly, human-intensive operations may struggle as U-Haul-style automation spreads. While U-Haul's strategy is compelling, risks remain. Its recent net losses suggest execution challenges and over-reliance on app-driven logistics could backfire if cybersecurity issues or service disruptions arise. Competitors like CubeSmart or Extra Space Storage are also expanding, intensifying the competition for the self-storage market. For investors, U-Haul's stock is a speculative bet on its ability to pivot its real estate portfolio and monetize its 24,000 rental locations. In conclusion, U-Haul's shift from showrooms to sensors is a call for investors to rethink how they value physical assets. The days of valuing real estate purely for its location or size are fading. Instead, the winners will be those who can repurpose spaces for modern needs, whether for storage, tech-enabled logistics, or hybrid uses, and adapt their workforces to the digital age. In Wichita, Kansas, a team of prominent developers has unveiled a proposal for a new hotel project valued at $40 million. This new development is set to breathe new life into a pair of historic buildings in downtown Wichita, specifically the Petroleum and McClellan buildings. The project is strategically located just across from the future Wichita Biomedical Campus, which is anticipated to open in 2027. The proposed hotel, named Hotel Indigo, will blend contemporary amenities with the charm of historic architecture, providing a unique offering in Wichita's hospitality sector. This development is expected to enhance the downtown area, attracting more visitors and potentially boosting local businesses. According to the Wichita Business Journal, the introduction of Hotel Indigo is part of a broader trend of revitalization in downtown Wichita, with several projects aiming to repurpose historic buildings for modern uses. This aligns with a notable increase in demand for downtown apartment growth in the Midwest, positioning Wichita as a significant player in this market. For investors and stakeholders in the commercial real estate sector, particularly those focusing on multifamily and tenant leasing opportunities, the Wichita development presents an intriguing case. It highlights the potential for historic building conversions to meet contemporary market demands, which could be mirrored in other North American cities. In comparison, cities like Kitchener-Waterloo in Ontario have also seen a rise in the redevelopment of historic properties, although with a stronger emphasis on mixed-use spaces that combine residential, office, and retail components. This cross-border relevance underscores the universal appeal of blending heritage with modern functionality in real estate development. In a noteworthy transaction, Newmark, in collaboration with United Properties, has facilitated the sale of Enterprise Business Center Building 7 for $25.5 million. This premier industrial property spans 157,942 square feet and is strategically located at 9,420 East 40th Avenue in Denver. The buyer, Dream U.S. Industrial Fund, an entity of Dream Real Estate Investment Trust, has acquired this asset, which serves as a cornerstone of the Enterprise Business Center development. Constructed in 2017, Building 7 is known for its excellent access to major highways and proximity to a robust labor pool. Executive Managing Director Mike Wafer and his team represented the seller United Properties in this transaction. United Properties, which began developing the Enterprise Business Center in 2015, has been instrumental in establishing this site as a key industrial hub in Denver's East submarket. The Enterprise Business Center is home to major tenants like FedEx, Coca-Cola, and Aramark, highlighting its strategic importance. The sale of Building 7 is seen as a strategic transaction for United Properties as they continue to expand their footprint in the Denver market. This Class A industrial property features amenities such as 24-foot clear ceilings, ESFR sprinklers, and high-end office and showroom build-outs, making it highly attractive to industrial investors. The property also offers a large truck court, enhancing its logistical capabilities. According to Newmark Research, Denver's East region is the largest and most institutionally owned industrial submarket, accounting for approximately 42% of the market's inventory and 62% of its absorption. This underscores the strategic value of the Enterprise Business Center within this competitive landscape. United Properties has a long-standing presence in the commercial real estate industry, with over a century of experience. They continue to invest in and develop industrial, office, retail, and mixed-use properties, enriching communities and creating lasting legacies. As we look at the cross-border relevance, cities like Kitchener-Waterloo, London, and Cambridge in Ontario are also witnessing similar industrial growth trends. These regions are seeing increased interest in industrial properties due to their strategic locations and access to skilled labor pools, mirroring the dynamics seen in Denver's industrial market. Hilco Real Estate Sales has announced a unique opportunity for investors and operators with the availability of a 290,900 square foot cold storage facility and development land in London, Kentucky. This site, formerly operated by the Laurel Grocery Company, offers significant potential for those looking to expand their logistics capabilities or enter the food-grade storage market. Constructed initially in 1980 and expanded in subsequent years, this facility is well equipped with 203,855 square feet of dry storage and 78,396 square feet of cold storage. It features 4 distinct temperature-controlled environments to accommodate a variety of storage needs. These include an ultra-low freezer, freezer spaces, and cooler areas, along with refrigerated loading docks and staging areas. Strategically located at the intersection of Kentucky Route 92 and Barberville Road, the property spans over 32 acres and is zoned for general business. This zoning supports a wide range of industrial and commercial uses, making it a versatile investment opportunity. The site's proximity to major highways, including Interstate 75, enhances its appeal for distribution operations. London, Kentucky, is experiencing steady growth, with infrastructure improvements underway to support this expansion. Notably, a $16 million road improvement project is set to enhance traffic flow and accessibility, further increasing the property's visibility and suitability for logistics use. This region's growth aligns with the increasing demand for efficient logistics solutions across North America. The offering includes an additional 7 acres of adjacent development land, providing opportunities for future expansion or complementary commercial developments. This could be particularly attractive for businesses looking to establish a presence in a growing market with strategic interstate access. Hilco Real Estate Sales highlights the potential for this property to restore quality jobs and strengthen the local supply chain, presenting a compelling case for investment. As the bid deadline of August 22, 2025 approaches, interested parties are encouraged to consider the strategic advantages of this facility and its role in the broader logistics and distribution landscape. Let's shift gears to a critical aspect of commercial real estate, leasing. A recent article by Sarah DeClercq highlights the importance of scrutinizing commercial leases to avoid common pitfalls. Sarah Jo Whitlock, Director of Lease Administration at Cushman & Wakefield, Sage Partners, emphasizes the need for thorough lease examination. She notes that many property owners focus too heavily on financial terms, neglecting operational clauses that can have significant financial implications. Whitlock advises that understanding the goals for a property is crucial when choosing between different lease types, such as a full-service lease or a triple net lease. Each comes with its own set of responsibilities for costs like operating expenses, taxes, and insurance. Clear language about these responsibilities can prevent disputes over costs such as heating, ventilation, and air conditioning maintenance or common area maintenance. One of the common oversights Whitlock points out is the management of utilities in older retail centers. Without separate heating systems, owners might end up covering these costs unless they are clearly allocated to tenants. Keeping track of lease dates is also essential to avoid missing renewal windows or automatic rate increases, which can be costly for owners. Whitlock warns against relying too heavily on template leases, suggesting that every building's unique characteristics require tailored lease agreements. Working with a licensed attorney to create a specific template can save significant time and effort in negotiations. A proactive lease administration team can identify potential issues early, providing critical support to property owners. Potential red flags in lease agreements include the absence of personal guarantees or security, excessive upfront requests from tenants, and restrictive exclusivity clauses. Owners should also consider how tenants might grow or shrink over time, ensuring their properties can accommodate changes and retain good tenants for the long term. As Whitlock aptly puts it, the devil is in the details. Investing time and effort in understanding and negotiating leases can prevent future headaches and ensure the property's goals are met effectively. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.